Hello, Propenomix people, and welcome to this week's live broadcast of Propenomix. And this week's was called Unbiased, and hopefully you'll find out why. Hello to the property and Propenomix community as well. I'm trying a double stream here for the first time, so please be kind and bear with me because tech is not my strong point. So I always like to start with a quote, and this week's is, "I want the news delivered unbiased." I thought that was the whole point with journalism. That's from Aaron Magruder, the American writer. So just before we kick off, we're just over 2 weeks away from the next property business workshop on Tuesday, the 1st of April, where the topic is due diligence. That's an entire day on due diligence back after popular demand and expanded on our last due diligence workshop in 2024, where we also covered two other major topics in the same day. So fresh content and ideas. We'll be covering due diligence on business partners and suppliers, due diligence on deals, due diligence on lenders and borrowers, the health of companies and what you can and can't rely on from Companies House, liquidation, administration and receivership, due diligence on deals with limited time or information available, credit ratings and how they really work, financial promotions and the FCA, and there'll also be a live due diligence exercise on some individuals and companies using some online tools. The tickets are live and they're selling at bit.ly/PBW6. We've still got early bird tickets available. They've still got a genuine 10% discount on face value. And when they're gone, they're gone. They're selling well and it'll be a great room. It always is. So we hope to see you there. Now, welcome to the supplement proper. The news has been around the US sneezing and everyone else potentially catching a cold. Now, the legacy of Trump 1.0 was very much that when the stock market said, hang on, mate, he did something different. And I don't think a lot of the companies caught in the tariff crossfire are particularly enjoying themselves. So I suspect we might hear a bit less about these tariffs as time goes on. 200% on booze from EU countries. You threaten me, I threaten you 4 times harder is the message, regardless of who started it. As usual, don't look at what actually is said. Look at what the bigger picture is. The problem has been always that tariffs are inflationary, and Trump thinks he can say stuff is black when it's white and vice versa, but the stock market won't lie and isn't interested in that. And neither is the bond market. Now, in the deep dive this week, I take a look at the Hometrack Rental Market Index, which was published last week, and also a recent publication from NIESR. That's the National Institute for Economic and Social Research. Bit of a mouthful, but they've been going a long time, very well respected, nearly 100 years old, that institution. And their research paper is called Housing the Economy. So you can see where it will be relevant to us. It's another fairly damning paper on the state of the union in housing, and it's the sort of thing informing the government as to the way forward from a policy perspective, or at least trying to influence them, which is why we're going to spend our time looking at it. So into the real time slot then, Chris Watkin and the Property Market Stats Show get another outing. We get to ask that question that we love to know the answer to. What is currently happening in the UK property market? Week 9 of 2025, remember we run 1 week behind with these, but this is as close to real time as we can get. And we see the listings data is continued to revert back towards the mean after a white hot start in terms of numbers of listings. But 2025 still remains the biggest start to the year for listings since 2016, if not before. Chris's data only goes back to 2017. It's still 8% higher than the 2024 number, which was, other than this year, the highest year for listings in the sample, and 17.6% ahead of the pre-pandemic average. My main reasons, well, if you leave out beating the stamp duty deadline as a reason for listing this year, I mean, you were pretty hopeful if you listed in the retail market on the 3rd of Jan and expected to get completion by the 31st of March, but some maybe tried it. For those who waited during 2023 and early 24, because the market was obviously not great. And also, there's a larger desire to get out of the market from soon-to-be ex-landlords. It can't be explained by there being more units or more completions or more repossessions or anything else that I could think of that I expected to be significant. But thanks to those who did suggest alternative reasons last week, shout out to Rod Turner, who suggested people moving to cheaper locations due to changes in mortgage rates. Now, that would show up in regional statistics if that was true. He also suggested moving abroad plans. We know we lost 12,500 millionaires estimated in 2024. But how many non-millionaires did we lose? Again, you could check the emigration figures when they're available. Also, people who had delayed waiting for lower rates that never came, hard to measure. And flats being unclogged after some EWS1 dramas going on that have rambled on for years and years and years. Some great points there, so thanks, Rod, for sharing those with us. 12% of stock continues to be reduced compared to 2024's average, which was a market of more stock than we've been used to again, just as 2025 shaping up to be. 2024's average is 12.1. The 5-year average is 10.6 for reductions. So more stock is leading to more reductions, both in percentage terms and in absolute terms. The gross sales still sit between 2021 and 2022's, although now on the lower end. 26,700 homes sold subject to contract in week 9, 25% higher than the pre-pandemic levels. 24.3% fell through. That's very, very close to the 7-year average of 24.2. Net sales press on 20,200. So remember, that's gross sales minus fall-throughs. So if there's 26,700 gross, that means 6,500 fell through to get to that net sales figure of 20,200. And 177,000 so far net sales in 2025 is 19% higher than pre-pandemic 3-year average to date. As at the 1st of March, there were 675,186 properties on the market in the UK. That was the most by a chunk looking back at the last decade's figures. That number was 623,112 on the 1st of March 2024 and 628,020 on the 1st of March 2019. And those were the 2 other highest years since. So we're 50,000 ahead of that in terms of stock, or about 8%. On the 1st of March 2022, there were only 399,915 homes on the market. So it's a huge difference. 7.5% up on that previous high of 2019. February's final pound per square foot figure was £340 a foot, which is down £2 a foot from January, which supports the wobbly market readings from Nationwide and Halifax. Sounds like sideways stuff at the moment. Now, I always like to give Chris a weekly shout out here because he's more prolific than just this epic tome he releases weekly on the UK property market. Drop him, he comes up with brilliant stats on a regular basis. Drop him a like, subscribe, and all the rest of it, please, because he does some great work for the industry, and it's all there for all of us for free to look at. If you're in the industry and you want a ghostwriter, that's his core business, so give him a shout. His article gets published on the Property Industry Eye website weekly, and the video on his YouTube channel, which is at Christopher Watkin, which I'd highly recommend you check out. And like I say, give him a like, give him a subscribe. Always helps out all the channels it's on. And while you're at it, if you wouldn't mind giving this a like and a subscribe and a comment, I'd really appreciate it. Thank you. So we sidestep from that real-time UK property market to get into our macro segment, just like a nightmare contestant from 1990. We sidestep to the left, we sidestep to the right. We'll take a look at GDP growth. We're going to have to look pretty hard at that, let's face it. The RICS residential market report, and then some data releases from S&P Global, including the KPMG/REC jobs report. We're going to round up with, guess what, the gilts and the swaps data in what was a trying week. Growth. I'm never going to tire reminding us of the great soundbite, growth, growth, growth. The thing is, this is the drum that Labour absolutely do need to bang. They've even shown a bit of ability to navigate some issues correctly. It really does seem like they mean it. Anyone sensible, though, knows they're not going to be delivering it in Q1 or even Q2 of 2025 on the back of the budget they knocked out in October. This is stagflation central, folks. The challenge to get Q3 singing will be the rising inflation number, dare I say, for the millionth time. But remember, GDP growth, imperfect metric that it is quoted net of inflation. That Bank of England Q3 peak prediction is based around 3.7% inflation. So it's even harder for the economy to grow when inflation is higher. Now, we had anemic times under the last administration. From late 2022, we really struggled. I can't think why. Any suggestions, let me know. Yes, that is a joke. Ironically, in Q1 and Q2 2024, Sunak and Hunt's sensible policies had actually kicked in, and the UK was growing quite nicely. But that soon got undone and disrupted by the change of government. And it had taken time to get here, or to recover from the lettuce, of course. Still, they had really huge inflation to contend with. And as I said a few times, it was honestly an economic miracle that nominal GDP did keep pace with that roaring inflation. Really not easy. You might think it is. With prices going up that much, tax take goes up. But inflation punishes businesses and consumers in so many inefficient ways that wouldn't automatically filter through in real time to GDP. Hence, we had an economy with an underlying natural growth rate of, say, 1.75%. That's close enough. Growing not at all because inflation was sapping it. We've ended up on the back of all that with a number of issues, one being sickness benefits as it goes, Labour MPs threatening mutiny, but ignoring us heading towards £100 billion a year for these. No one's asking the tough questions on the left about why this has utterly exploded in the past few years. And government is ultimately about tough conversations. Respect to Sir Keir Starmer and Rachel Reeves if they can handle this one, because it absolutely must be handled. Sunak identified it and then called an election, if memory serves me correctly. So the expectation was 0.1% growth. I predicted more like minus 0.1 to 0 as a more realistic range. And indeed, it came to pass that we hit minus 0.1. My primary driver in my prediction was the outperformance in December, where again we expected 0.1, but we hit 0.4. Now, the PMIs, in my view, are not a fabrication, and there's no way that the jobs tax isn't hitting what's already a difficult time. It's difficult because the trust isn't there yet in the Labour government. The reality, however, is looking a little different to me. I have very few political conversations, but the ones I do have, I try to make meaningful. I do have a think tank I speak with on a quarterly basis that is close to the housing side of policy in government. It's a bit of a quarterly rant, to be honest, where I reel off all the mistakes that are being made, but supported by the data. Temporary accommodation would be one example. This time round, I did say to the other side that I think Labour's attempts at populism light are quite clever. That will include cuts to welfare, as discussed, and deporting criminals born in international jurisdictions. I'm sceptical but pleased to see these policies that will appeal to in the centre to the working person. If we get through the spring statement period, and we're about to go into a 2-week or so period of announcements that aren't in the statement, but are being made around the statement so that it isn't a budget, and have no tax rises. Now, on a recent poll I ran on LinkedIn, 47% still believe that more tax rises are coming this month. And they're likely there but not there. For example, chipping NIESR allowances, which apparently is being shelved for another day, or just freezing tax thresholds, just as the Tories did for 7 years. Well, then we might see a more practical approach. April will come, jobs will be shed, but investment decisions will come around. If it's a one-off shock to business, business will adapt because that's what it does. You can argue that if it's cost around 0.8% in GDP, now a case could be made for 1% of GDP fairly easily or more, and that's on the basis of where we were growing and then what the growth rate shifted to in anticipation of the budget and then after the budget. That cost is about 8.7 billion quid to the exchequer. Now that's fairly close to the amount of headroom wiped out or estimated that will be confirmed by the OBR in the lead up to the spring statement. So the maths there, just for a minute, GDP around £2.85 trillion, 0.8% growth, 22.8 billion. The government hold, or the increase in the tax take as GDP goes up, is roughly about 38%. That's 8.664 billion. So raising 25 billion, which is actually more like 16 billion on national insurance, that's 16 billion because you have to consider A, what national insurance the public sector has to pay, and B, the difference in corporation tax from increasing the cost base of companies. So the increase of this 25 billion, which turns out to be 16 billion, has actually had another cost of about 50% of that, or more than 50% of that, if it cost 8.7 billion quid's worth of growth, which just shows how problematic the situation that ever faces the Chancellor is. And how many times can you keep going back to the tax well again and again and again and again when we already have the highest tax burden for 70 years? Now, this simply harks back to the old economic saying, there's no such thing as a free lunch. This leaves Reeves with further problems, though, as you might imagine. We're still behind the 8 ball, and we will be until we get this growth. So, how did the growth shape up? Services up 0.1%, continued resilience, about in line with the PMIs. Production and construction falling, once again in line with the PMIs. Production dramatically so, 0.9%. Construction less so, 0.2%. But those on their own were enough to move us from plus 0.1 in services to minus 0.1. I've said it many times, but it's just depressing when we're splitting hairs between 0.1%. And it's always better to be on the positive side than the negative, as we are this time around. You could just view December and January together as a bit of an anomaly and poorly forecasted. Some, Rachel included, point to Trump being to blame and imports come off GDP because that's the way that they're calculated. So this spectre of tariffs meant a lot of inventory building and imports in January. So mathematically, she's correct when she says that. The same actually happened in the USA as well, where recession has now been mentioned, although anemic growth is much more likely until the volatility stops, assuming that it will. Now, if there's truth in that, and it is true to be clear, but how much difference it really makes is the question, there will be a bounce back accordingly at some point. The PMIs are around the 0 to 0.1% growth mark mainly, which is why December's 0.4% number made very little logical sense. But a bit of smoothing, and this is why we look quarterly rather than monthly as a rule, sees an expectation of another 0% in February, bearing in mind manufacturing and construction PMIs dipped again as realistic. The sensible range looks like minus 0.1 to plus 0.1. And if we do get another negative print for Feb, we would see the quarter still be positive, or the last 3 months, thanks to December. But it's March's figures that are the important one, because that's quarter one of 2025. December's figure will have dropped out of the figures there at that point. Now, this means we need a pretty good March, and I'm not sure we're halfway through one as I'm recording this video, to be honest, because NIESR still see growth at 0.3% in quarter one of 2025, which is far braver than I'm willing to be. They say that's in line with the PMIs, but with the composite PMI at 50.6 in January and 50.5 in Feb, I just cannot see where they're getting this bullish number from, to be honest. At the moment, I'd say 0.1% would be a result for quarter one. So let's see what happens. There are a limited number of other surprises in the GDP report. Accommodation and food and beverage had a tough January. In other news, sun rises in the east and sets in the west. From a construction perspective, new work is still 6.1% down on 2022 numbers, and repairs and maintenance is up 17% since then. Right, I can't go on for any longer about no growth at all or a small contraction, so off to the RICS residential market survey. The headline is in line with the Watkin real-time numbers, sales market activity softening ever so slightly. The suggestion would be here that the stamp duty bump is going to have less impact than other bumps in the recent past. That makes complete sense because the difference it causes is not as stark. £2,500 extra tax on all houses above 250k, not bought by a first-time buyer. And that's phased in, remember, between 125 and 250. And then the first-time buyer tax impact is higher, 7,500 extra, 7.5% extra, 7.5k extra on all first-time buys above 425 grand. Now, in some parts of the country, that sounds pretty outrageous, to be honest. But to some places, it's not enough to buy a flat, of course. This disproportionate impact may not matter that much in London because so few new flats are being built anyway. But that's not the right attitude, let's face it. Perhaps Rachel has some surprises up her sleeve to cheer the big house builders up when it comes to first-time buyers. So, the RICS don't want to alarm anyone, but new buyer inquiries and agreed sales turn mildly negative in the survey. Momentum appears to be moderating, prices still rising, but less than inflation at the moment, you'd think. And a further gentle softening in sales market activity is expected in the month ahead. Sounds like the effect of a fairly small clip in SDLT, to be honest, and not much more than that. However, this is one of the reasons why my house price prediction for this year was quite moderate, 3.75% if you didn't see it. New buyer inquiries, 14%. New sales agreed, minus 13%. So both of those are negative. Near-term sales expectations, minus 5%. These are quite big swings from January, about 15% moves from January's report to February, so quite significant. Now, over the next 12 months, outlook for sales is plus 32%. Still very positive, but the least positive reading since the end of 2023 as it goes. So still plenty of new instructions, as we know from Chris Watkins' numbers. So once again, Chris's numbers are validated, and the balance, which is the main figure everybody watches from the report, is down to plus 11%. Price growth is tapering off. The glut of stock and the transactions pushed over the line by the stamp deadline have cooled people's ardours somewhat. Now, lettings-wise, headline tenant demand is at minus 4%, which I'd agree with, the fourth negative month in a row, the longest stretch without a positive reading ever since the data set was formed, which is 2012. However, landlord instructions still fall with them at minus 22%, and plus 34% see higher rents as supply is still cratering faster than demand, according to RICS. This will continue to be ignored at a policy level, of course. Okay, S&P Global, got a bit of room here to explore some of their other reports other than the PMIs. I'm going to start with the REC report on jobs. Starting salaries rise at the slowest pace in 4 years. That will keep the rate setters at the Bank of England happy somewhat. It's something they've been referring to for over 2 years now. The outsized moved upwards in wages when you think that the inflation target is 2%. A week doesn't seem to go by these days without me reminding everyone that I don't believe the 2% target anymore, and I think that 3% is the new 2%. Then a modest increase in salaries, staff availability up and vacancies falling further, but a softer decline in permanent placements and temporary billings. Almost exactly how you'd expect the market to react to an economic shock, such as the increase in employers' national insurance, announced back in October. I describe this one as a non-negative write-up from the commentators, including the Group Chief Exec of KPMG, who said businesses that are well capitalised will be looking for signals to support future planning and growth. And with that will come confidence to invest and create jobs. One of the more positive pieces of commentary from any of the S&P PMI and related reports in the last 4 months. The S&P UK Business Outlook is less positive. That report leads with UK firms expect to shrink workforces over the rest of 2025 amid gloomy profit outlook and activity outlook. It refers to plans from both services companies and manufacturing firms to shed staff over the course of 2025, which is more in line with my expectations following the activity in the budget. Perhaps more worryingly, profit forecasts turned negative for the first time since October 2022. I guess that's my allowance for October 2022 references met once again for today. The final key finding in the report is that inflation expectations for both staff and non-staff expenses have accelerated, which again is not in line with the results from the REC report. Now, this data was collected in February, it's collected quarterly, it's a survey of about 12,000 manufacturers and service providers. The future employment level sentiment was negative for the first time since June 2020. UK employment expectations were lower than anyone else surveyed. Now, this survey goes out to a dozen of the most large or developed economies in the world. But in spite of the negatives, firms still expect activity to increase, just not very much. The plus 25% number for business activity compares to 18% in October 2022. Did it again, oops, which in itself was the lowest number since the global financial crisis. The commentary resonates, unfortunately, because it points to stagflation, which does look highly likely with increasing inflation. However, a really significant rise in unemployment does look unlikely. And whilst economists disagree, stagflation is normally characterised by high levels of unemployment that are persistent. I prefer to call this current situation that we're in treacle, which I started referring to back in 2023, because I think that's a better analogy. Progress, forwards just about, but really very slowly. So the best conclusion we can draw is there are mixed signals, which is arguably at least means all the signals are not negative. The overall feeling when looking back over the past 4 to 5 months of miserable reports that the worst has been absorbed, and therefore the next couple of months of releases of government data, because we have a lag, will be fairly miserable. But post-April, perhaps the services sector particularly will continue to show the resilience that it has done over all the years I've been producing this supplement. That leaves the gilts, and it was another up week on the yields, unfortunately. 4.212% at the open, ended the week at 4.287 on the 5-year gilt, so about 7.5 basis points up. Not a disaster, but it is still another up week. The big drift this week was really in the US markets because, as referred to after another messy week in the stock market, as the US crossed the threshold of the stock market being 10% down on its most recent high, and Tesla has lost 50% of its value in just 3 months, the bond yields went upward on the back of inflation data, which was heralded as a victory for Trump supporters rather than looking into the actual detail. The markets don't get political, they are instead clinical, and a bond sell-off after a Monday rally had an impact in the UK as well, as it often can do. Often the market would have trimmed the yields on the back of a negative growth surprise, which is what we had in Friday's growth numbers. And I often say when the market doesn't do what you would expect it to do, you really need to take a note. This is one of the most negative signs for bond yields since early January, when yields were charging upwards and the short sellers in the bond markets clearly still have plenty of confidence and money in the tank. Rates aren't moving downwards anytime in the very near future, certainly not at the coming Bank of England meeting on Thursday this week. So Thursday's 5-year gilt close was actually pared back relatively near the end of the day to 4.235, and the swap at Thursday's close remained at under 4%. 3.964% is very similar to last week's reading, and also just about above 1 month ago and 1 year ago, which were both in the low 390s. We are well over a year now without too much significant movement in the swaps market, suggesting we've found our level at a 4% swap rate until something material changes in the economy. The expectation for figures for 5-year limited company debt still needs to be at 6% for the foreseeable future, folks, I'm afraid. Okay, suit up for the deep dive. First up this week is the Hometrack Rental Market report released earlier this month. The Hometrack data is used by the vast majority of UK top lenders and is part of the wider Zoopla property group for those that don't know. The notable headline figures, that's 3% annual rental inflation for new lets in the UK, exactly at the figure of inflation and where my expectation is going forward for new lets, between 3% and wage inflation, basically. There are still 12 renters chasing every available home, and London's figure is up 1.1% for the year on new lets, which suggests that heads are butting against affordability ceilings. So actually, if you take London out of the numbers, the number was 3.7%. But this 3% number nationally is the lowest for 3.5 years. It suggests that the crack-up boom in rents is over. In fairness, this has been the case for the best part of 6 months as far as Zoopla Property Group go, although their figures were closer to 4% when I last reported on them. 1 year ago, that 3% was 7.4%. Now, number of homes for rent are up 11%, and rental demand is down 17%. So that balance has redressed itself a little, which is taking price pressures off. But 12 renters chasing a home is 42% down on the 2022 to 2024 numbers, but it's still higher than before the pandemic. The Hometrack expectation is in line with mine, 3 to 4% rent increases during 2025. The 17% down year-on-year demand is still 79% above 2019, just for full context. So supply is only down 22% since then. So demand is driving about 3/4 of this price movement. It's not quite as simple and as linear as that, but possibly thanks to outsized population increases in the interim. The report drills down regionally. Every area of the UK has a higher stock of homes for rent than 12 months ago, other than the West Midlands, which is down 10%. The North East and Scotland, the areas with the highest yields, have supplied the most stock, which shouldn't surprise anyone. So next is an interesting point. Rents are rising faster in more affordable cities. This is congruent with the observation that affordability is the governor in this market. Hull, Liverpool and Portsmouth are at the top end of the increases city by city, compared to Nottingham, Leeds, Brighton and London at the bottom end of the rent increase percentages. Areas adjacent to big cities are the ripest for continued rent increases, Hometrack concludes, and that looks like a sensible conclusion. UK ex-London is actually at 3.9. Sorry, I misspoke earlier when I said 3.7. Such is the drag on the figures from the London market. Both the South East and the East have seen more like 4% increases in the past 12 months. Now, it's always an insightful report and worth spending some airtime on, but I'll move on to NIESR's recent report entitled Housing the Economy. They kick off the intro in the report by describing a troubling trinity: rising homelessness, growing queues or high payment burdens in rental housing, and then difficulties in entering home ownership. They point to multi-decade socio-economic changes, but also failures in governance as chiefly to blame. Governments fail to grasp how housing outcomes frustrate goals for stability. Agreed. Higher growth and productivity. Makes sense. Fairer distributions of wealth and residual incomes. Agreed, with an expanding PRS alongside a shrinking social system, if indeed that's where we're still at as of today. It's certainly where we have been for several decades. And then progress towards net zero. Now, I remain sceptical here because there's no doubt that in the UK, a large percentage of the man-made emissions come from leaky houses. But the production of energy is the subject matter that would have and still would provide the most bang for buck when it comes to net zero. Anyway, the need, as NIESR frames it, is to make housing affordable and expand home ownership. The recent decade or so has been a slow move upwards after post-crisis repair, although affordability has been whacked by normalised interest rates and rents moving up above inflation, which is an unusual phenomenon that hasn't occurred in the 15-year period before the pandemic, not for any sustained period of time anyway. The factors are listed as high immigration rates, which is rarely mentioned because of its political status, but economically factual, growing student numbers, high down payments, stress tests, and now higher mortgage rates. This appears to be another tip or precursor to the incoming regulation easing for mortgage rates, which looks likely to occur in the coming weeks and months. Then there's a really classic reporting naughty bit. I couldn't really think of a less reflective piece of analysis than this. Between 1992 and 2022, average house prices rose by 377%, and median household disposable income only by 51%. I need to spend a couple of minutes here. Where do I start? Well, 1992 was a year at or very near the bottom in the movement in house prices in that cycle, which, even if we just start in 1980 rather than tell the full story, saw house prices treble between 1980 and 1989, with right to buy and massive credit expansions taking place to support right to buy and the broader market, and then saw house prices correct by 10% between 1989 and 1992. And that was in nominal terms. There was huge inflation back then. So peak to trough, houses lost about 35 to 40% of their real value after inflation. So 1992 was pretty much the bottom, which is very convenient to choose 1992 if you're looking to make a point about a rising cycle since then. Then 2022 is the complete opposite, we know, of course. Before the lettuce, September 2022's figures, which was settling, as she settled briefly in 10 Downing Street, were not seen again until August 2024 when it comes to house prices, when inflation had done a serious amount of heavy lifting in that time, and indeed household incomes had moved on. So, to make a point, we're comparing a bottom to a top. That's naughty. It doesn't change the point being true. House prices have outstripped median household disposable income. Sure, the magnitude of it would change significantly if we chose different time periods. If I chose 2004 to 2024, for example, the last 20 years, which you think would be reasonable, house prices haven't moved at all in real terms. Other points would have to include the fact that between 2019, 20 and 2022, 23, the average household in the English Housing Survey went from 2.4 people to 2.2 people. That's a really significant change, over 8%, and would dramatically impact household incomes. Fewer people in the household to make money. Now, the EHS only goes back to 2008, 2009, and it's hard to find data on the number of people per household in 1992 in the UK. But the ONS estimated 2.48 persons per household in 1991. It's not a huge decline since then. They estimate about 2.36, but still, it's something that makes a difference. If a household on average is smaller, it also needs or demands smaller accommodation. And we need to make that point here to make this a reasonable discussion. The next point is that income and wealth have shifted against the three poorest deciles. In recent years, that point around income is unlikely to be accurate in the UK, with extreme rises in the minimum wage in percentage terms. If we use my 20-year range as an example, rather than lament the giant credit expansionary terms of the 1990s, including the advent of the buy-to-let mortgage, well, I shared a graph this week from the equally respected IFS, the Institute for Fiscal Studies, who show median household disposable incomes in the past 20 years after deducting housing costs. It just proves the oldest point in the world. Lies, damn lies, and statistics. If the vast majority of the difference in the figures listed in the report is on the basis of what happened between 1992 and 2002, then at least say so. But that's now 20 odd years ago. Now, NIESR presses on with reporting on the pie-in-the-sky 1.5 million homes numbers, but unlike many other reports, do mention the numerous issues that there are in achieving this. They categorise the goal as not only unachievable, but also too limited. Remember, thanks also to the changes in the fiscal rules, that borrowing to create assets is allowed, and so there's more scope for that to be done almost independently of the cost of doing so, assuming it's invested wisely and assuming that the bond markets go along with that, of course, because we would need them to do so. The numbers being thrown around, which are in the millions, are a tiny fraction of what would really be needed. Less than 1%, I'd estimate. There's a very insightful paragraph that follows about the PRS. The first point is that extra regulation doesn't necessarily deter investment. I think that needs to go a bit further, because what it misses out is that if the rewards are high enough, then the supply will go up in spite of the regulations. It also misses the point completely about the pain of transition between a tiny fractured market with 1 to 3 property landlords dominating the supply, and how at that scale it will be so much more difficult to be in touch with all the necessary regulations. However, next up, they address build to rent and make the obvious point that this targets middle and upper income rental demands, not low income needs. Impossible to disagree. Then a thumb in the eye for Scottish rent controls, nearly phased out anyway, simply saying that poorly constructed measures have deterred investment. There's also criticism for the LHA freeze, the benefit cap being hit by inflation, the bedroom tax, and the two-child benefit cap. This isn't the first time this critique has been levelled, and it won't be the last. The critique is, in my view, factually accurate, but the cost-benefit analysis is not one that is shared widely, or indeed at all. Then there's a historically fairer summary. Home ownership rates rose until 2001. 71% of households owned their own home. This moved to 65% by 2024. That's the wrong direction, of course, in those 23 years, but not an epic disaster. It also did fall significantly after the global financial crisis and has been in repair mode and going upwards slightly in the past decade, which NIESR choose to omit. The next point they make is around not overstating the importance of planning regulations here, which I'm in agreement with. Planning reform is not the only answer. The housing market is becoming increasingly driven by family wealth, excuse me, and less by income. And mortgage lending to the bottom half of the income distribution is shrinking. It's a stark comment, but a fair one. However, we need to not have a return to the ninja lending of 2007, of course. If you remember that one, no income, no job, no assets. Still, the challenge for Rachel Reeves, or more accurately the FCA, is to strike the right balance. The suggestions are to look at longer-term fixed-rate mortgages, a point that has been made for 20 years, and also if the Bank of England should put more focus on the productivity effects of sustained increases in housing prices. Here's where that problem in the 1992 to 2022 analysis versus my 2004 to 2024 analysis rears its head again. As I said, between 04 and 24, house prices haven't moved up above RPI inflation in that time. That's a 20-year time period. So how much can we explain in anything when we're just continually discussing a nominal price rise which isn't responsible for that much? For example, the price of a 3-bed semi doesn't change drastically because fewer people stay married, or fewer people get married in the first place, or fewer people cohabit at all or have children, right? We're talking about apples and oranges here. NIESR's suggestion is to revert the nation's most widespread speculation system back to the steady savings, low inflation housing system prevailing before April 1972. I really don't know what to say here. Rarely is going back to the 1970s the answer. Openly doing whatever it takes to reduce house prices would destroy consumer confidence, destroy wealth in 2/3 of UK households, and render anyone who did it unelectable for an eon. Or tell me where I'm wrong, please, in the comments here or on the tube. The next point is long and involved about government departments collaborating to achieve outcomes. Definitely true, highly unlikely would be the conclusion, I think, until the government can be run by AI that is wise enough to understand that when you move A and B, it impacts Y and Z, often with unintended consequences. Perhaps that utopia isn't actually that far away. But is it going to stop politicians wanting to remain elected above all else? I doubt it. So we reach the conclusion of the report then with 5 strands of further change that are critical in NIESR's opinion. Stop fostering the rentier, you might be familiar with the phrase the rentier class, rather than the entrepreneurial economy. I'm not sure any landlords at this time really feel that the rentier economy is being fostered, but there we go. There is some merit deeper within this point, though, to change the view of homes to one that recognises that the housing situation shapes consumption and production patterns of people and places, and higher housing costs reduce investment in other forms of growth-inducing capital. I'm not sure that's a problem we've never understood, because if we think about new towns and things like that, they need to be designed well, and that's why chartered town planners, apart from anything else, are so important. But a great framing of the problem without a solution, it seems like to me, just a point of where and how to focus. Speeding up planning won't be sufficient. High rates are one issue, which, as often discussed, are not high historically. But if you accept my characterisation of the last 20 years as the relevant 20 years, they are high, and indeed on the high end of the range since 2003, 4, 5, even if you ignore the post-crash ZERP years, alongside shortages of labour, materials and critical infrastructure. Accurate and damning. the need to incentivise to bring forward the delivery of affordable homes from the Let Win review, and also the fact that easier planning might just grow the stock of unused permissions. Point 3, levelling up has disappeared, but regional solutions are needed, not just local ones. Good point. Whether devolution will help with that, I'm not sure. Perhaps it will. Housing tax reform needs to start. Tax must be included in the review. It will be difficult and slow. Labour already pulled out of reviewing council tax in 2024, and ultimately the fear will be community charge, poll tax focused concerns, of course. How to upset everyone? Mess with council tax. There's a claim that housing outcomes are towards the top of political agendas, but this isn't in line with the YouGov weekly polls around people's top political priorities. Housing sits below health, the economy, immigration, just below crime, and well below defence for the moment, for obvious reasons. So people definitely care, but they are 2 or 3 times as likely to be concerned about the economy, immigration, or health than they are about housing. And remember, this is politics. And then the wider outcomes of housing need to be fed into a newer and more sophisticated model to make big policy in housing actually work in a meaningful way. It would be very difficult for anybody who knows anything about housing policy to disagree with this. There's been a huge issue without having a joined up policy. Is that coming soon? I hope it is, but I'm really not sure that I do believe that it is. Let's see, I guess. But all in all, very interesting, very big picture report. But I've got some very significant concerns over the biases in the data that they chose to use. Now, where we're going in all of this remains to be a significant question, but I really don't think NIESR have framed all the answers there at all. So remember to book your tickets for the 1st of April for the next property business workshop on due diligence. It will be the most comprehensive day on DD that will ever have been delivered in the property space. I can guarantee it. Join those who've booked their early bird tickets here at bit.ly/PBW6. And above all, please remember to keep calm. Always listen to or read the supplement and carry on. There will be opportunities abound this year and towards 2030. The risks around at this time, while they feel significant, the geopolitical ones, are far less meaningful to the UK housing market than they have been for several years. Of that, I have no doubt. Good luck, everyone. Thanks for watching.